Gotta remember that when it comes to budget time.
A lot of people don't even know it's a
Remember,
mill.
next year is
All right.
millennium.
Operations. Will the operations committee please come to order? And Bob is gone. I have no minutes. Unless you have minutes.
I attached them.
Oh, excuse
Joyce.
me.
We do. And I made the corrections that
She
David
resigned?
Boaz had pointed out needed correcting, so you have corrected.
Where's Grossman?
You did a good job.
Where's Grossman?
No,
He's
Bob
not
did
here.
that, I just
Ed.
counted.
Grossman.
Oh, doctor's appointment.
Let's just take a minute for you to read the minutes. Has everyone had a chance to actually look at them?
Yeah.
Too busy talking. What did we work?
I did.
I said to
It'd be
you,
good to have a look if there are any questions.
I'll tell you, Bob Trevino does a very good job.
Absolutely, I agree.
No?
I do. We're ready. You ready?
Is good? David?
Bob.
You okay?
Fine now.
Fausto? Fausto?
Yes, sir.
Minutes okay?
Yep. I'm reading right now. Bob Romero.
Oh, Bob. Bob is attending by telephony.
Hey, hi, Tony.
Hi, Bob.
Hey, Tony.
How have you
Boy,
been?
good luck on hearing.
Amazing we recognize each other.
Should have thought about this. We could have plugged him into the PA system.
Glad you're here.
It's a little late now. He'll probably have the cable.
I was running late this morning, I didn't want to move. Rainy weather.
Microphone's
At least we
on.
gotta have before it starts to pour again.
All right, Bob. We can barely hear you. Hopefully you can hear us. Because we're not using mics for obvious reasons.
MAS, I got it, and
We'll talk on them and touch them, and we don't want to be passing
looks
them
good now.
around.
Everybody
Okay.
hears anything?
Hearing no questions on the minutes.
Yeah.
Gone. Minutes will be accepted as presented. Thank you, Lena. And be mindful that we're recording the meeting as usual. And now what we're going to do is Assured Partners first. Yes?
Yes,
Yes.
yes. So that everybody knows, in case you weren't here, I think we have a couple of new faces that might not have been here when we had the presentation by the three insurance agency a couple of months ago. The committee selected Assured Partners to do the insurance program, and the current policy or program expires July 31st, so we're just right around the corner. So they've been working very, very hard, and in fact, Phil and I were working on this, I think, till 11 o'clock last night, so unfortunately it's not a really pretty picture, but I think you expected that based on what the three agencies told us a couple of months ago. So without further ado, this is Phil Massey. For those of you that don't know, I'm with Assured Partners, and this is Christy Lawrence. Christy is their claims expert, and she spent 2 days last month with Thompson through all of our communities with the risk assessment fellow Fred Sebastian out of Ohio. So they've been doing an awful lot of work on the ground, and she has become intimately familiar, unfortunately, with the 8 years.
8 years of losses. We went
Lost
back further,
runs,
but
yeah.
when Deerfield was involved, it was difficult. So.
Yeah. So they've gone through all of our claims and classified them, categorized them. So she's become very familiar very quick, unfortunately, with our general liability claims. So anyway, without further ado, I give you Phil.
Perfect. Thank you very much, Monica, and thank you guys. I appreciate the time to come out here. I was going to start a little slow in the beginning and just kind of reintroduce myself a little bit and Assured Partners for the new folks in the room. I won't belabor that, and then I'll get into who isn't here, and then talk about the market a little bit, and then we'll get into the West Palm Beach program. So just real quick off the bat, my name is Phil Massey. Massey. I'm with Assured Partners. I've been doing this for 15 plus years. I have 11 years. I worked at Brown & Brown previous to moving over to Assured Partners for the last 4 years. I'm actually a native, well, I was born in New York, we were transplants, moved to South Florida, so I grew up here in Palm Beach County, and then went to Orlando for college. I have an accounting degree, worked at Deloitte & Touche before the insurance side, so that's kind of a little background. What I think separates me a little bit from the prior agents you've probably worked with and met is that I'm an expert or niched into the community association arena. I insure 500 plus condo associations around the state. I've got my CIRMS designation, which stands for Community Insurance Risk Management Specialist. That's the highest designation an insurance agent can get to specialize in the community association arena. I'm the president of 4 large condo boards. I don't know why I do that, but I do that as well. And I go to 150 plus board meetings a year. I'm a CEU certified instructor for the CAM license, the Community Association Manager license. I teach over 8 courses around the state, both virtually and in person, mostly virtually these days. And so I live and breathe this stuff. When it comes to what your property insurance should be at any part of the state, that's what we do. So we know this stuff well. Also, I worked on this account last year. So last year I worked with Monica, met your team, bid this account out. So I was intimately familiar with the type of work we were going to have to do. We came in here, well, right before that, just AP for a second. So Assured Partners is about the 10th or 11th largest insurance broker in the country. So if you don't know who Assured Partners is, that's fine. It's only about we started about 7 years ago, but it's private equity run. We've grown fast. We own about 20 agencies inside the state of Florida. So AP is a large agency as well. And if you need any more info on myself or them, Monica can provide it, or I can digitally, whatever else you need. When we met last, it was at the end of May, and our presentation, along with 2 other insurance agencies, was basically everybody saying the same thing to you, that the current insurance carriers that the Senville program had on both the property and the liability lines were likely by far the most competitive and will continue to be. You've actually been with these same carriers on the general liability side for 10 plus years. They're well suited for the type of risk that we're writing here. But we started talking about, well, what else can your insurance agent do for you? What other services can we bring? What other things separate us from the competition? And so we went over a lot of these things. One of the most crucial was a loss control assessment that was performed a few weeks back with a guy named Fred Sebastian. So I don't know everybody here that knows the people that aren't here, so I'll kind of go through them real quick. But Fred Sebastian works for Assured Partners. He's our risk control expert. He's been out to this property now 3 times, once remotely, digitally, and the other 2 times in person. And Ty Beba, who you know Ty for a long time, he used to be the agent and originally wrote this account years back when he was at Brown & Brown. He's involved as well. And then a lady named Jenica Mandarano, she's the account executive that would be looking over this account on my team with me. And then Christy Lawrence, who's here, is our claims expert, and she lives down here in South Florida as well. And Christy and Fred and Ty did the tours of the property just recently. What Fred's team did was create what's called an eye auditor report. And I promise you, we just got this last night. So a lot of this, and I hope you bear with me in it, this all happened in a very short period of time. We were granted the right to be the agent in the beginning of June and had basically a little over a month and a half to put this together. And so Fred's team came out less than a month ago now, and then they finally completed their report last night. In a perfect world, if we had more time, I would have the presentation for you showing you the details of this report, but Monica has it, and it's something that we can share with everybody if needed. But the report is very, in the most nerdy insurance term, cool. It is, because you've got a Google map over this property here in West Palm Beach, and you can hover over it with the mouse and see exactly where the issues that Fred's team found. So for example, you have a pool gate that's not self-closing and self-latching. Fred finds it, takes a picture of it, notes it on the file, and he's provided this documentation to Senville so that Senville can go and make these repairs to various things that are damaged around Senville's property. That does 2 big things for you. One, it's going to prevent, hopefully, future claims, because you guys do have a lot of slip and falls, so a lot of the report was surrounding slip and fall issues. But 2, and probably most importantly, it's such a great document for us to use when we're marketing your account to other carriers to quote, when we can show a proactive report that Senville did, and then also show the corresponding repairs that were made to each one of these items, that you guys are a better risk to insure than the average account. And so that was the goal of what Fred's team did. And it's not a final product yet because obviously it takes time to do it all, but we were able to use that this year in your general liability renewal. Just the concept of what we were doing, some of the basic stuff that we gave them. You'll see the general liability renewal is the one of the three major lines that came in much better than we had projected it would from a pricing standpoint. So that's the great news in the proposal. The bad news in the proposal, and it's unexpected, but the general liability performed better than expected, but the property and the umbrella coverages we knew were going to be challenging renewals, and they pretty much came in where we thought they would, if not a little bit worse. And what I wanted to do second, before I go over this now, is kind of talk about the insurance market as a whole, so you guys can have an understanding of what we're up against and what's going on in the marketplace and how it's impacting the Senville program. And stop me at any point if you want to have questions or anything. So to start, who here, and I'm sure a lot of you were involved in this insurance program back in 2006 and 2007? Might have been a few of you familiar with that. You remember, so probably a lot of the group. So Hurricane Wilma came through here. You had Katrina, Francis, Jean, Ivan. I mean, just a tremendous amount of storms. Charlie in Central Florida.
That's what took place now.
That's right.
They hovered over the coast right there. Those were bad. And if anybody remembers what happened right after that, isn't unsimilar to what happened after Andrew hit, but the insurance markets paid out tons of claims. There was a jerk reaction in the market. What's reinsurance is a term I want you to be familiar with, but that's the insurance that the insurance companies buy to back them up. So when reinsurance rates go up, it gets passed down to you guys, and the insurance rates go up. So back then, the property market got extremely, what we call hard. It went up considerably, and the rates, a lot of places went up by 5 times what you were paying previously. The numbers were just crazy. And so that was what we considered a hard market. So 2006 and 2007 were very difficult times to buy property insurance for this account and a lot of other accounts, especially in the state of Florida. So now, fast forward, we basically, ever since that point, had rates that came down year over year. There were some blips when the tsunami hit in 2011 and some other stuff, but over time, we had 11 years basically without our landfall and hurricane in the state of Florida, and we had rates just go down, 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 down. And they probably reached the bottom in the 2018-17 year. So 2017 was probably the bottom. That was right before Irma hit for you guys. So August of 17 was your best renewal, no doubt. That was the bottom of the market. Irma hit in September 11th, 2017, right afterwards. And you could start to see that more storms were coming. We had Harvey, had Maria, and that was a really bad year, and things started to flatten out. So instead of continuing to go down, they started flattening out in 2018. We were doing those renewals. But something unique happened in the property world that didn't really happen as much in 2006. The world of private adjusters. Everybody know what a private adjuster is. It's insurance. You can hire one to fight on your behalf for your claim. But we had so much legal and litigation on these claims that a storm like Hurricane Irma, I filed initially maybe 100 Irma claims. I'm up to about 250 on my accounts now. Basically everyone eventually files one. And we were replacing roofs that, 3 years after the storm hit. The amount of money that Irma cost in reinsurance is incredible, right? So those storms that hit, and then of course Michael in 2018, and then we had Dorian and other issues with fires and things like that. The property market hardened out. So rates last year for you guys were up about, give or take 12, 13% on the property, 15%, and it's trending, continuing, increasing beyond that in 2020, and we expect probably will continue through 2021. But what's unique about the 2020 market is the general liability and the umbrella were not issues back in 2006. Like your liability rates and the umbrellas were sort of easy to get. They did not get impacted by the whole hurricane issue. But this year, general liability has been under tremendous pressure. We've been talking about that since last renewal, of something called social inflation. you watch the news, you might know that term. But what that basically means is the jury awards, the Morgan & Morgan ads, if you're used to the plaintiff attorneys, and what slip and falls are costing just due to medical payments and tactics. It's all exorbitantly more than it used to be. So people are more apt to sue. When they do fall, the medical bills are higher, and the outcome of those claims are worse. Okay, and you can see that play out over time. So personal looking at this, back 10 years ago, I had tons of slip and falls. They happened. We used to close slip and fall claims for $10,000 to $20,000. That was considered like, oh, it's annoying. I can't believe they paid that claim. Now slip and fall claims are 50 to 100 to 250,000. I got one. This is just yesterday. Hung up the phone with this client. A lady woke up in the middle of the night because she heard noises at her pool. The pool is a community pool. She got out of her condo unit, outdoors, middle of the night, and Christy's our claims person hears this, walks outside, not on the path, but she's going through the grass area, trips on a root. That claim settled out for $60,000 for her medical bills. We were irate, obviously, and we get after our carriers, we hold them to that account a lot. But we were very frustrated because I'm like, what is the association supposed to do? The root is supposed to be there. It's in the grass. I mean, like, what are you supposed to do? I mean, it's not like the root was growing and pushing up pavement or creating a trip hazard. And so that's the way the world is moving. And so the general liability side, especially on community association type exposure, is just getting, the market has changed fundamentally from where it was even a year ago. But worse off than that has been the excess market, the umbrella market. For years, umbrella claims, it was very rare to pierce into the umbrella, or certainly the higher levels of an umbrella. That's just not the case anymore. I mean, the claims, the general liability underlying carriers that are writing the first $1 million, they're writing $1 million checks pretty easily now. And the umbrellas are picking up claims a lot more than they used to. And for some more history for you guys, if you go to 1984, that's when the $1 million underlying general liability limit started. They've not adjusted that since. So adjusted for inflation, $1 million back then is like $4 million today. So the $1 million goes a lot faster and the umbrellas get hit. So the umbrella market is just, it's nothing like it was. So when you compare last year's program to this year's program, you almost can't do it. It's just the market has shifted so much and so fast in the last 12 months, it's just fundamentally different. Overall, from a coverage perspective, it's the same stuff, but what the cost of that is just gone up, and especially on the umbrella side, significant. So that's just some of the background on the market, some of the stuff. Yes, sir?
How will or will coronavirus affect liability and umbrella policies?
Beautiful question. See, I always trust you guys, people that listen and help me when I miss something. So, of course, it's noted here, I was supposed to finish the cherry on top, you helped me there. So the coronavirus. So the coronavirus has taken a bad situation and basically, you know, let's say you broke your leg and you're laying on the ground and then coronavirus comes around and just punches you in the face. It's like just not helpful, right? It's not making the situation better. So the coronavirus impact has been felt in multiple ways and all negative. So first, from an insurance coverage perspective, there's no expectation that the property insurance market or the liability market is going to pick up corona-related claims. The carriers are all denying those claims, and I could get into the details of why, but basically there's a consensus that believes that those claims will all be denied. And we've seen our accounts, if you're familiar with the Las Olas companies, that's one of our insurers that own the Riverside Hotel and all that, dealt with a lot of these business interruption related issues. The coronavirus is not going to be covered from an insurance perspective based on the current programs everyone has. That's kind of a general thing that we all believe. The problem is
the policy has language in it, not pandemics are not covered.
Yeah, it basically straight up says there's a virus exclusion in most of these policies, and then outside of that, you also have to have physical damage to trigger a property policy. And there's severe argument and doubt of whether the coronavirus causes physical damage. So I'll give you an idea. If the coronavirus is on this table right now, does that mean it's damaging the table? And the thought is if you just wait a few days, it will die and you won't have to do anything. If you need to clean it, you can clean it, but it's not really causing damage to the physical structure. And that's what's required to trigger an insurance claim. One of the good analogies I heard is like your car. You know when pollen season hits and your car gets full of that yellow pollen? Is the pollen causing a loss to your car? I mean, it's the same way. It's sitting on the surface and then it needs to be washed off. Now you can argue that, hey, well, the virus was there and it caused damage because we had to close down because of it, we needed to do enhanced cleaning. So there's different litigation that's going to happen from this, but that's what's so bad about it, is the insurance carriers are mostly denying the claims, but there's hundreds of thousands of lawsuits now against the insurance carriers that they have to defend, and there's a claims expense to them. So you have an increased claims expense to defend these cases through litigation. You also have the way insurance carriers make money. A lot of times they don't make money writing your insurance, they make money taking the premium and investing it. And obviously we had bad investment results in the first quarter. It's bounced back a little, but they usually do very safe investments. And you look at fixed assets, their interest rate levels right now are so low that the insurance carriers aren't making money on your money. So not only are they losing money on the underwriting and the claim side, but they're not making money on the interest side that they would be. So coronavirus has been a bad cherry on top of it. It's basically taken a situation that was worse and then just made it worse than that. It's made it more difficult and things there. Now, one other quick thing I'll say is when we met in May, we were projecting what we thought would happen for your insurance premiums. You remember, you guys were asking, we were talking about it from a rate perspective. And general consensus was that we were expecting the property rates to rise probably around 20%. That was kind of what we were throwing out there as what we were seeing in the marketplace. And as comparison, last year they went up like 12 or 13%, and we felt that this year was going to probably be 15 to 20%, and 20% probably being what we would have bet on. What happened in between then and now is the reinsurance renewals for all the Florida carriers occur on July 1st. July 1st is a big reinsurance treaty date. June 1st too, but mostly July 1st. That was worse than anyone expected. So there was a much less reinsurance available, and the cost of it was so much more than what we had seen in the past that what we had projected ended up not coming to fruition for most of our insurers. So it's still going to take some time to work itself out. But I went from an average renewal of, okay, if we can keep this, we told them 10 to 20%, we keep it at 15%, we're good. Now we're seeing stuff that's 35, 45, 50%. The numbers are just materially different. Now here at Senville, that's not the case. It didn't hit the 20% mark, but we're still in the mid-20s, about 25% rate year over year. And it's not wonderful and great, but it could have been a whole bunch worse because, as we'll get into this proposal, we'll show you in the market summary section. I mean, the alternative options, it could have been another 20%, we'd still be with the same carrier at Amherst. General liability, we thought that was going to go up 15 to 20%, ended up only coming in about 5 or 6%. Incredible renewal. So it helped offset that difference in the property side. The umbrella is the shock, and not shock because we knew it was happening, but is the most egregious from a percentage increase perspective. We said that was probably going to double, go up 100%. It ended up, at the end of the day, being up about 128% for the same limit you were purchasing before. So that $30 million umbrella, same $30 million, just more than double what we were paying previously. And again, that was expected based on what we saw with other renewals, and the trend is similar. And I know it sounds crazy saying this, but you actually dodged a bullet in a way, because Philadelphia, who remains your general liability carrier for the last 10 plus years, they not only gave you a great general liability renewal, but the umbrella, they were doing last year for you 10 million of the 30 million limits. You buy 30 million in limits, they were doing the first 10 million, the primary piece, which is the most expensive. This year, they said, we're no longer offering 10 million, we can only offer 5 million. But still, that 5 million is by far the most expensive piece, and had they not done that, the cost of this would have likely tripled. So I mean, as much as it went up, just having to go and buy that other 5 million in another market. So not only is Philadelphia your best general liability option, they're even so much better because they're willing to write the primary $5 million of your umbrella. So they're by far the best option here, and any agent should agree to that. So that's a whole bunch of talking, I know. I'm just going over the markets, but I want to set the table for it so you understand. The overall, though, for Senville, there's not a whole bunch changing. There's some positive changes, there's some negative changes, but there's no major carrier changes. There's no significant coverage differences or things we've got to kind of get over, with the exception of a few small items. So we're going to go over the proposal. I'm going to kind of talk you through some of the points, and then I'll kind of wrap it up at the end. But if there's any questions at any point to this, just obviously you can let me know. We have a lot to pass around, so yes, sir.
Are you also the agent for Boca and Deerfield?
Boca and Pembroke, yes, sir.
Pembroke.
We have Boca's today at 2, and then Pembroke tomorrow. Yeah, and so it's also an interesting thing that we're able to do here, and we could talk a little more about the claims front, but one of the benefits of bringing us on, and we spent weeks, Christy especially, working with Senville's team, building out, you have these general liability loss runs to build the loss run data so that we can actually look at every single one of these Senville properties, who's driving what, where the claims are coming from, what's open, what's not. So we'll talk about that stuff a little bit too. But I'm just going to walk you through the proposal, and we'll, again, this is something that we'll kind of chat on some of these things. There's only really one option to talk about from a coverage perspective, which we'll get at. But let me know when everyone's got one, and we'll kind of walk through some of this. And Monica, feel free if you've got anything you want to add as I'm going through it. Okay, so just looking at the very first page real quick, August 1st is the inception and expiration date of this program. It always has been. You guys do have some other coverages at Senville Purchases that comes up in December, which we're not going to talk about today, but the program you're used to insuring and renewing every year is this one, and it's August 1st is the date. Page 4 breaks out the named insureds for different lines of coverage. That's something for Monica that's reviewing, nothing for you guys to focus too much on. And then page 5, just briefly introducing these people again. Myself, Jenica and Christy, Jessica Tratt is Jen's assistant, and then also not listed on here being Ty, Beva, and Fred Sebastian, who you guys know as well, from a team perspective. All right, so page 6 is where we start into the meat of it. Page 6 shows $33,086,051. Those are the total insured values that the West Palm location is insuring in this property program. This is up 8% year over year. So you guys every so often have an insurable value appraisal update. And you had an update at the end or in 2020 from Prestar. And so Prestar did the update, and West Palm's numbers increased by 8%, okay? So the values of 33 million were 30.6 million last year. So we got an 8% increase in values or exposure on the property program. But everything that's listed here was listed before, it's just for slightly increased values. If you turn to page 7, it's going to go over the kind of nuts and bolts of the property program, and I'll walk you through this. Most of this is the same with a few changes which we'll talk about. The valuation on the program is replacement cost, which is what you want, the business interruptions, actual loss sustained, which is what you want. That's identical. Cause of loss is special form, which is the best one, includes the broad form sinkhole. All that's identical. No co-insurance penalties or issues. That's the best term you can get. You reject terrorism. You've done that historically. And then the monthly limit of indemnity just means that the business income is 1/12 is what they pay, which is what you've had as well before. As you get into the deductible section, this is where we have a choice year over year. So the deductibles are identical with the exception of the hurricane deductible. So the all other peril deductible, which is anything that's not, just say not wind related, so fire, lightning, sinkhole, car drives through the building, pipe burst, that's going to be $5,000 per occurrence. So if one fire burns 2 locations, it's still just $5,000. That's not changing, that's the same. The hurricane deductible, we have choices for. So the carriers, as well as increasing rate, have also increased deductibles. It's part of how it goes, part and parcel. Especially in Tri-County. So you guys, when you double down in kind of situations, Palm Beach, Broward, Dade is the epicenter of anything that ever happens, right? Good or bad, I guess, mostly bad when it comes to insurance. And so the deductibles in this county, very common now, that the carriers aren't willing to put out less than the 5% number. So last year you got a 3% with the 100,000 minimum per occurrence. This year they quoted a 5%. We pushed back on them to get a 3% option, and so we have that in red below where we've got an option for 3%. There is something unique here that we were able to develop. The property program is one of the programs, that and the umbrella, that you share with the other 3 locations, and the carrier allowed us to actually let each location decide if they wanted to pay more for the lower deductible, the 3% versus the 5%. So it's something that the whole group doesn't have to do. You can individually choose whether you want it or not. And the reason I gave you the choice is when we're looking at 25% rate increases, I didn't want to assume you'd want the lower deductible. Because, you know, from a financial perspective, if it was lower, I would just say it's a no-brainer, take the 3%. But when there's rate pressure like that, I wanted to at least give the option to you guys on if you wanted to do that or not. So if you look there, that 5% was 3, and if you go down in the red below, in the double asterisk, it'll show that the hurricane deductible option to decrease from 5% to 3% is an additional $21,000, give or take. We can just say it's that number. You don't have to worry about the taxes and fees piece. It'll be right about there. And so that would lower the deductible from the 5% to 3%. And if you look at your worst case scenario, you're insuring $33 million. So every 1% drop is about a $330,000 reduction in your worst case deductible. So if you do the math on that, that's about $660,000 in lower deductible for about $21,000 in more annual premium. That's kind of the math and looking at it. Now, one thing we did to make an improvement in this program is that last year, your deductible applied per calendar year. So if you got hit with multiple hurricanes in the same calendar year, it would just be 3% deductible or 5% deductible. We amended that to actually go to policy year instead of calendar year. And I know that might seem like it's not a big deal, but I'll explain why. Because of your date, you renew in hurricane season on August 1st. If you got hit with a hurricane on August 10th and August 20th, that would be in the same calendar year, 2020. But what happened then if next year in July you got hit with a hurricane? That would be a different calendar year, and so it would be a whole new deductible. It would take away the advantage of that aggregate deductible. So we changed it to a policy year, so you truly have one deductible from August 1st to August 1st. It kind of eliminates the potential of there being a problem. That was something that really should have been done before, but it was something we caught and corrected. So that is now on there, and it applies on again on a policy year basis. So the really only question there is whether it's something that the association wants to take a 3% or a 5% if it's worth that difference in price. One other thing to note is that the deductible last year was a hurricane-only deductible, which means the percentage deductible, the larger deductible, only applied in the event of a hurricane. I asked the carrier, AmRisc, if they'd be willing to give you any return premium if you lowered it from a hurricane-only to a named storm only. And they were willing, I think it says, you have updated copy, like $3,000? Yeah, so $3,000 off that figure to go from a hurricane to a named storm. The reason I did this, it might seem silly, but if you think about it, what's really going to cause a $100,000 loss here? It's likely going to be a hurricane. So yeah, can a named storm, just a tropical storm, do it? Yes, but the hurricane is really what we're all worried about. So if the board was looking at this and saying, okay, well, for 21 grand, we want to go to a 3%, there could be some more additional offset if you wanted to take the named storm deductible, and maybe it's only 18 grand or something like that to take the 3% of the named storm versus a hurricane. So those are the two options, if you will, inside the property program. And that named storm deductible, when we were pushing for that, the carrier didn't want to give you a 3%. They certainly didn't want to do the named storm, so we kept pushing back, and that's why we got that literally last night. So it's handwritten in mine, and you guys got it updated. So this kind of stuff went to the last minute, bargaining and pushing, continuing trying to make it better. So any questions on that page? Yes, sir.
Yeah, I have a question. If I read this correctly, should we have a named storm and we do damage? There was a $100,000 deductible per building?
No, it's per occurrence. So the minimum.
That's not what it says here.
So when it says the 5% with the $100,000 minimum per occurrence.
Per building. It says
Yeah,
right there.
I apologize. It's just confusing the way it looks. The 5% deductible applies per building. The $100,000 is the minimum deductible. What that means is, let's say you had a storm come through, a hurricane, and only damaged one maintenance building, and it was $10,000. It wouldn't have reached a total of $100,000 in damage, so it wouldn't count. It's likely not going to come into play here because if a hurricane hits, you're going to likely have more than $100,000 in global damage. So the deductible that you really focus on is that 5% per building. So the $100,000, I apologize if it looks like that, but the $100,000 is just the minimum total deductible you have to hit, and then the 5% applies per building. So the $100,000 is not per building. And I can, we can amend that.
Please correct that.
Wording if it's confusing. It's just, but again, identical to last year. That did not change. So $100,000 max minimum deductible, the 5% applies per building. And we'll make a note just to make that clear, crystal clear on that side. Yes, sir. Yes, sir. Oh, Tony, hey. You got a mask on.
Mascot. Well, we all have mascot.
Yeah.
I think that right now would be a good time to take a vote on on whether or not we want to reduce the deductible from 5 to 3, just so we don't forget anything.
No, I would agree with you. You're
I
never
mean,
going to
and
know
we're
more than you
here,
know right now.
and I mean, it's probably going to be 4 or 5. And Monica's giving lunch today. No, Monica's going to.
I'm going to Boca.
Boca. But anyhow, I just think that it's a good time. Now it's clear in our heads what's going on, and we have the whole committee here. What do you think? Take a vote.
Tony, other than the no-brainer component, what are you recommending?
I'm recommending that we take the 3%.
And I'll give you my 2 cents on that. When they quoted the 3%, you got to think the behind the scenes of what we're doing. We're fighting and arguing with the carriers, and they're giving it. I thought if they quoted the 3, it was going to cost a lot more than it ended up costing. So to me, I would agree 100% with that, but I didn't want to just assume that and just put that there. I wanted to make sure you guys had the option.
Let's take a vote.
Okay. If you want to,
Motion.
I'll recommend.
Make a motion.
I'm going to make a motion that this committee chooses 3% deductible on the property coverage for a premium of $21,000. That's it.
I second it.
Thank you.
David? I have the vote sheet here, but I don't have Tony's name on here as part of this committee. Is she on the committee?
Yes.
Okay.
They got rid of me when I got sick.
I'm just going by the sheets that I.
Yeah, you're right.
She helped found a committee.
No. No, I'm the biggest pain in the neck on the committee. Is what
No,
it
you're
is.
not.
I never said
You're
that.
right.
And this is number 2. He's sitting behind me.
So you're recommending to take the 3%
Yes.
Is
instead
there
of
any
the 5%?
further discussion on this one? Yeah.
I'm new on the insurance committee. What are we paying for the $33 million insurance? What is our premium?
Okay, so the premiums at the end are going to be, we're going to get to them. The total premium is for the 33 at the 5% is $147,057.
$147,000.
Yeah, and
I
so you're
have
looking
a
at.
one-page comparison
Yeah,
that I'll
oh,
hand
yeah.
out after they finish, unless you'd rather me hand it out now.
Well, if they're gonna go,
The text,
It'd
goes
be
by
good to
line of
see.
coverage, what
yeah, I
the,
remember, I was
expired-
actually looking.
what the expired premiums are to what the new
Yeah,
premiums
right.
are.
And
That's
I
what
have
we
it here
wanted
too,
to
so I was going to go over that when we get to the premium page and kind of dig through that stuff, but it's up to you guys. Yes,
So if we add the 21, we'll be paying 168?
yes sir.
Okay.
Yeah, and your property rate, just as another sidebar, is right now is, I say only, I don't mean to trivialize it, but you're at 44 cents at the 5%, it would be closer to 50 cents property rate. And again, that's for $33 million in West Palm, older construction. I mean, those rates now in Orlando are what I'm selling on a daily basis are in that range. I mean, the rate is very competitive for West Palm based on what it could be. I mean, I always feel, by trade, I guess I get nervous, but I don't like when my second best option is 30% higher than where I am, and that's where we are here at Centerville. If you look at your property quote and your general liability with Philadelphia, the second best options are tremendous jumps up. I mean, so you guys are by far lower, which is great in the current term, but it scares me for the future. I'm always like, if one of these markets went away, it's such a material difference in that jump. Now, granted, the markets will change and there'll be things that come along, but right now, you guys are, I would still say by far, are still sub-market. No doubt about it.
I would just note, I believe the latest thing I heard was we're 6 or 7 named storms, right? And I don't know if that's ever happened this early in the season.
They say expect the worst. Everything I've seen, everything I read, it's expect
Let's
the
say
worst.
this in passing.
No, this is the year to do it. I mean, you have
Yeah.
El Nino and La Nina. El Nino tamps the storms down, La Nina spins them up, and there's La Nina right now. On top of 2020, what else do you need? I mean, if anything bad's going to ever happen, this would probably be the year, right? So, I don't trust it.
Bottom line is, I think that we're talking a trivial amount for the coverages that we're getting, for the increases that we're getting. There's no point in us, nickel and diming. That's okay. We're going to get them when it comes budget time. That's what we sharpen on.
Have any further discussion on this before David calls it?
Call for the vote.
All a vote.
Barbara,
Yes.
Ruth,
Yes.
John Gregg,
Yeah.
Richard Handelsman,
Yes.
Joyce,
Yes.
Patricia,
Yes.
Tony,
Yes.
Kitty,
Yes.
Dominic,
Yes.
Stuart,
Yes.
Fausto,
Yes.
David Boas, yes. Dave Israel,
Yes.
is Bob still with us?
Yes.
Bob voted yes.
Thank you.
All right, so that went bad.
Unanimous.
All right. Well, I think that's a good call, what I would have done. So, perfect. And the rest of this will go faster. That's the only thing we had to kind of do that on. Page 9, if you move forward to it, I want to point out one item on this page that's also the last market change with the property program. We bolded it there. The roofs, and you do have some roofs here that are going to fall into this category, but in Tri-County, so Dade, Broward, and Palm Beach, any roof older than 15 years, this is carte blanche with AmRisc, it gets valued now at actual cash value, which is the depreciated value of the roof. If the roof's been replaced since 2000, 2005 or after, it gets the full replacement cost value to it. This is something that in my career we've always pushed back on and try to get the what we call the ACV or actual cash value date as far back as we possibly can, but we are maxed out at 15 years here. So you guys are currently getting the best terms AmRisc could give you, but I do want to make sure you're aware of that in the event that we obviously do have a storm that hits and you're looking at that. Now, it's another reason why you want to buy the 3% deductible like you just did, because it doesn't eat in both ways. But that was another thing that I always point out in my renewals, make sure the associations understand that that piece there. But other than that, all identical there on page 9, but I'd just be remiss if I didn't bring that up. Okay, so that's property. The equipment breakdown program on page 10, the only difference here is it's up 8% in value, just like your property was, because you have more appraisal values. It shows a $100 million max limit, but this is because it's shared with all 3 associations. This is your least expensive coverage. This is not a huge deal. Everything here is identical to what it was last year. $2,500 deductible, identical to last year. There's no changes here except for the value increase. The premium is very small on that line. So that is there just to round out the property program, bringing that equipment breakdown coverage. Skip ahead to page 12. This is the general liability. This is, if you were in those meetings with Monica and I early on, we were first talking about this account, is where I thought we were going to see the most pain at the renewal. Because based on what general liability was doing 6 months ago, it looked like it was going to be the worst. Property ended up getting worse, umbrella fell off a cliff, and the general liability was bad, but that came in better than anybody had expected. And so when you look at the general liability here, same carrier Philadelphia that we've had now for 11, I think going on to 12 years. And if you look at the coverages above, the $1 million, $2 million is the standard general liability coverage program. The deductible is 0, so first dollar coverage on your general liability. Again, something that has gone away these days. You see now $5,000 retentions applying per claim. That is not the case here. You're still getting first dollar coverage in Central. All 3 of the properties, which is very good to say, especially again in Tri-County. When you look at the class codes, the exposures below, there were some changes to these exposures. So the square footage, for example, used to be 86.9 thousand in this building. It ended up, actually it was a little incorrect, we've moved that down to 82.7. And as you go down these things, there were some other changes. The sports courts were 42, we lowered them to 38, and we did the audit on them. We did add the lake and the dock that weren't there. So there were some changes to this. The clubhouse theater stuff, I won't get into the nitty gritty with it because I know that number may not make sense. We just kept that the same because there was a lot of question on theater revenues, and it wasn't worth kicking that hornet's nest with Philadelphia, so that stayed that way. That actually benefits you guys to do that. Shows the additional interest. So this page is pretty much identical to last year with a few little tweaks on exposures. No differences from a coverage standpoint. As you get to page 13 and 14, it just goes over the coverage forms and exclusions. This is another, I'm sorry, yes sir?
I think I know what it is, but would you tell everybody what the additional interest part means to everybody here?
Monica
I
might be
can
able
tell
to
you that,
better.
that is the mortgage company for Benenson Capital.
The mortgage company.
If you remember, Benenson Capital actually owns the real estate under the long-term lease.
They took out a loan.
They've always had a loan, and every year I have to send them a certificate of insurance so that their mortgage company knows that
This
the
is the
property
same
is
loan
insured.
at something like 13%.
I know nothing about their loan, honestly. I just know that they have a mortgage on all of this property.
Huh.
Yeah.
It's a huge rate. I would have thought that would be renegotiated.
They may have. I mean, I would certainly assume that they would have over the years.
Yeah, it's not uncommon for
Yeah.
to put a loan on it to get the money out of the property, but I don't know what the rate is. It's just the bank would require this. It's not costing you money to have this.
If it were the original loan, it goes back to the 80s, so I
Sure.
can't imagine that they
That's-
haven't refinanced the loan at some point
20% interest rates.
over the years, yeah.
Thank you, Monica.
Do we have 10?
Incredible.
If it's still that, I want in. I can't imagine. I'll refinance it for them somehow. Yes, yes.
What are the premiums?
The
General
premiums.
liability?
Oh, yeah, the
Before and
Unless
after?
it's
sure. So
I
the
guess we
expiry
Century Villages.
was $115,018. The renewal's $119,741. So only a $4,000
The bottom line
change.
is, you got no deductible, and you had a deductible, didn't you?
No,
last
there
year?
was no
Not last
deductible. It's
year.
remained the same.
Barbara?
Oh, it's me then.
We have 10 pools, Monica?
Yes.
Okay.
You have the 5 satellite pools, you have the 3 at the clubhouse, and 2 at Hastings.
Oh, Hastings is in, okay,
Yeah.
okay.
So this program, and what I meant by the deductible wasn't that it was changing year over year. It's just as the market hardened, deductibles are being added to these programs at pretty high rates, and this one being able to keep it off is a good thing. Then on page 13, what I will point out, with Philadelphia, another big advantage of them is they don't have weird exclusions. When I say weird exclusions, you have to be very vigilant against these carriers adding certain exclusions that remove coverage. One of the most popular ones is assault and battery. They love to put assault and battery exclusions or assault and battery limitations. Philadelphia does not have that on their program. That is one of the worst type of liability claims we see. Someone gets sexually assaulted, or someone gets beaten, or robbed, or whatever the deal might be, and the association of the property gets sued for it. You don't want that. You don't have that here. Also, you'll see like canine exclusions or animal exclusions. That stuff is not here as well. The only thing that is a little out of the ordinary is the abuse and molestation exclusion that they have on their program. And that is something that we actually fought to try to remove this year because and we probably could have years ago rather easily, but in the past we would be able to remove that exclusion by providing a letter saying that there was no daycare operations here, because you guys have a very small exposure to child molestation here. It's just not, you don't have children regularly. And so we were going to put that, I know.
But we do have sex offenders.
Well, in this particular scenario, what they're worried about is like after-school programs with children and things like that. So normally we can get that removed because you don't really have the exposure. But this year, after their treaty renewal, they have to charge to remove it, and the charge was stupid. It made no sense to pay that much money to get rid of that exclusion. If it was a few bucks, but they wanted more than you're paying for all your pools to remove it, and it didn't make sense. So we just kept that the same as it was last year. We show the option in the back, but that's not something that I would buy or recommend to buy based on your exposure. But that was something we did push on. But other than that, everything else in this program is you would see at any other condo, any other master association or property that's similar to yours would have the same or worse than this. I mean, you don't have weird exclusions here or something missing. And then if you, and again, you've got complicated exclusions here. Oh, and I will say on the top of page 14, you will see the communicable disease exclusion. We highlight that now so you can see that for people that were wondering about corona being covered and stuff. We just make sure we're pointing that out on the program. Page 15 is the auto program for the 3 vehicles that the West Palm Beach location has, the Toyota Tacoma, the Dodge Ram, and the trailer is not a vehicle, but the trailer that's on there as well, the Big F trailer. And $1 million in coverage. Nothing is changing on the autos. This is identical to what you currently have. It's with Philadelphia, which is another big win, and the umbrella sits excess of it.
It's covered in Gators.
No, that's on the.
That's the next page.
Equipment floater.
Yep. So if you get to page 16, you're going to see all the Gators here. So the Gators are going to be the top 6, the 2014, 2018, the John Deeres, and then the Sunfish sailboats, and then the John boats and the Scissor lift. And if you look at it, last year this value was $114,000. It's been increased this year by about $17,000, so it's about 16% up year over year. This is not an expensive line. I'm just mentioning what's different. So these values did change a little bit on there, as Monica's constantly doing that audit of these things as well, and we did the walk around with her, and some of the stuff got picked up. But that is overall pretty identical to last year, with the exception of the increase in values. And all that really was, I think, the Genie deal.
We actually have 15 sailboats here?
17.
17.
17?
7 to 21, so
That's what it says.
14 on here.
I see 7, I counted 15, but I could be wrong.
Yeah, 15 is what we currently are showing. If that needs to be amended, it's easy to do, and the cost of it's minimal. So if we needed to increase that, we could.
Confirmed
Yeah.
a month ago, so.
Yeah, unless you lost or added in the last 30 days. So
And
we've
they
been through
added
these
the 2
exposures.
other boats, that's why.
Another good thing I'd say, and obviously Senville helped a lot in doing this, Monica's team, but I mean, we went through every exposure down to the square footage and stuff. So we should be pretty accurate on the things that are on here, but obviously this stuff is always changing, so.
Mike, I have a question for you.
Yes.
How come we have 2 sailboats with no serial numbers?
Because they can't read the serial numbers on the boats.
Then they should be gone. They shouldn't be here.
You could paint a number on them or something and just use that as an identifier. Like it is in like if you don't have the serial number and you can like attach like a number 10 or whatever boat, you could do that and we could use that as the identifier. If it,
Bob?
I heard it. Do you want me to repeat it?
Yeah, we do have a few registered sexual offenders, and I think Bob's question is, well, you have grandkids that are visiting here all the time, and if they revert to type, any of them, is there coverage for that?
Well, I'd say a few things here. So one, it depends on where it occurs. So if it occurs inside someone's unit, then it's an individual issue. If it occurs on one of the condo association properties that are within here, then it would be the condo association. If it occurs here in this clubhouse or in one of your amenities that Senville's in charge of, and you get sued for it, saying, hey, you know, this child was abused and molested, and you guys are responsible, then as this coverage currently stands and has for years, there would be an exclusion for that. That would not be covered under the program. So that answers that question. So it depends on where it happened. Obviously, anything can happen at any time, so there's always that piece of it.
Well, it depends, as he said, it depends where it happens, Bob. But if it happens on Senville, on Senrec property, it's excluded, if I understand you.
Yeah.
Yes.
Yeah.
Yeah, and if it happens on a pool or amenity owned by an association or an association hallways or something, it would be association. If it was inside a unit, it would be unit.
Right.
So you can't go to the pool anyway, but I don't know, so. Isn't it the responsibility of the other
It's not necessary. Even if there was.
children under 16 cannot go to the pool without, is that correct?
Yes.
Yeah.
So I don't see how that would happen with children.
Well, and you have to remember too, you in this world, I've learned that you don't really need liability, but at the end of the day, or negligence, but the association still would somehow have to be the cause of this, you know, like whether it was an association employee. Normally when we see abuse and molestation claims, and I've had 2 in my 15 plus years of doing this, it was association employees that did the molesting, and in one of the scenarios, it was someone who was an adult age but wasn't able to consent due to a mental incapacity. Like that, those are the type of scenarios where we typically see it. It's a Senville rec employee or board member or somebody related to the association.
Word association.
I know I'm using that word. I know I'm not. It's
When you
not.
say association now, you're talking Senville.
Yeah, and so I was just saying.
Senrec.
Yeah, I was using it as an example. Like if you just look at a condo association, but if you talk about Senville rec, then it would be their. Usually, the way these claims happen is it's their people. So what we talked about with Monica, if this was a coverage that was wanting to be put on, there would actually need to be training for the employees that are here for the sexual harassment stuff. That is actually something that if you felt as a middle ground, you keep the coverage off, but it might be something worth doing the training anyway. So you had some training for the employees. We could do that.
My feeling for your question, Bob, is it's an exclusion.
I don't.
We need kids.
Good.
We need kids.
No. We're discussing Senrec insurance now, not your association. Not
Correct.
right?
Yeah, I apologize if I confused you.
All right, Bob.
And just to give you an idea, so you verbally have it in your mind, the quote to add the abuse and molestation, Philadelphia was willing to do a $100,000 sublimit of coverage for an extra 12 grand, or a full $1 million for an extra 20 grand. And I'm just like, the numbers are just stupid as a percentage. So it just, that's the problem, right? I get it, we want it, but it was the money wasn't worth it for what the risk is you have here. And if it was, I was hoping we could get it for free, is what I was obviously trying to do. So that was the numbers. It's all on page 24 later if you want to see that. So it was, we did our due diligence, it just didn't make sense. Okay, so now the last coverage we'll talk about here before we get into the
Hello.
the last coverage
What time is your appointment?
we're going to talk about here is the umbrella program. So the umbrella program is going to be shown on page 18. You still have the same $30 million aggregate umbrella that all 3 properties are buying together. And I will tell you all right now that the biggest advantage of the program, with you guys being on the same page with Boca and being on the same page with Pembroke, obviously it helps on the property side this year. This was a year where it would have hurt to break up the association, so it actually helped us being part of it. But the umbrella is very much the same way, because had we had to buy our own $30 million umbrella for just here, it would have cost the same amount as this is costing for the whole thing. So everybody would have basically been paying another 100+ thousand. I mean, it would have been significant. So the $30 million umbrella is identical to last year. The only exception is, remember how before I told you Philadelphia did the primary $10 million? They're now only doing the primary $5 million. So we had to go out to a carrier called Princeton Excess, which you'll see on page 18. They did the $5 million excess of $5 million to build the first 10. And then we went Starstone, who was actually on your program last year. They did the 10x of 10, so they came in there. And then Endurance American Specialty did the 10x of 20. Crum and Forster was on your account last year. They quoted the 10x of 20, but they quoted it more expensive than Endurance, and it's the same coverages. It just didn't make sense to stay there. So you'll see that in the quotes in the back too. So same $30 million limit, just broken now into 4 carriers instead of the 3 that you had before, and still led by Philadelphia. It's just a whole lot more expensive. There's no additional really material changes to the program. And the next few pages just go over each one of the coverage forms on the umbrellas, and the future higher levels start removing liquor, but it's nothing they really need to dig deep into. All the stuff is pretty much follow form and the same on there. So page 23 is the premium page, and again, if Monica's already handed out the, you didn't? Okay. So the premium breakdown, just to kind of go through this, page 23, what you see, and I apologize that the number on the top is written and crossed through. We printed 20 of these before that changed, so, and Christy just written in with her hand, but I apologize. That was the only thing that was different. I didn't want to, we couldn't do anything about it this morning, so that is handwritten on there. But if you compared last year versus this year, 110,000 to 147,000 is that number on the property side. Year over year, and again, 8% of it was value driven from the appraisal increase, and about 25%, give or take, was rate driven increase on the property side that we talked about before. As you go down from there, the equipment breakdown was virtually identical. We actually moved carriers. You were with Hartford Steam Boiler, we moved you to Travelers, because Hartford doubled their price and Travelers kept it the same, so that worked out. The general liability, as Tony asked for, was $115,000, went to $119,000. With Philadelphia, that was the big win of the year. Very, very minimal increase on pricing. The auto basically stayed the same, $6,187. Inland Marine, same thing, went up a little bit with the increased values, but basically the same. That's the equipment floater. And then the umbrellas, where you'll see the big change. So last year you paid just under $30,000, so $29,880. And this year, $71,876 is the number for the portion that is for West Palm Beach. So you could see that difference there is 100, give or take 28% more than the expiring program. And then that gets you the overall difference, which if you look at here, give or take about 30%, 267 to 348. And again, this is pre the 3-5% thing we talked about earlier. But that's how we broke that thing down. And we can do all of this again and make sure the final numbers, I'm sure as Monica will, that it'll be even more transparent. You'll be able to see the differences where they finally flow in. But this should be pretty damn close to what it ends up being. And again, not really the only surprise was the general liability not going up as much as it did. Property came in harder than we expected, but not really for what we're seeing in the market. And then the umbrella did what we thought it would do. The hope is going into 2021, if I kind of put my, my Nostradamus hat on or whatever and look at it, 2021 it's going to continue to harden. I don't see this market not continuing to harden. It's a long ways away to know what will happen on next year's reinsurance renewals. Assuming no storms, that's a big assumption right now, but assume there's no storms, knock on whatever we can. My expectation is the property will continue to harden, but maybe not at as big of a clip. The umbrella shouldn't move like it did the year before. That's kind of finding its new spot. So I feel like the umbrella will hopefully start to, even out. And so we should see some more, some closer, not as drastic of differences come 2021, assuming that stuff plays out. The general liability and the umbrella, what's going to help too, and I don't want to sit here all day and keep belaboring this stuff, but what's a really good thing that we did on this page, I'm going to hand this out just to talk about it, but you do not have to, it's going to be a small document, so it's totally okay if you don't want to look at this or can't see this. In a perfect world, we would have put this on the big screen, and next year we'll have a lot more ability to do that with Fred's stuff out there. But this sheet, I'm going to just talk you through it real quick so you can kind of understand, because I feel like it's a pretty good thing. What this sheet is, I basically was able to take, with Christie's help and Senville's help, we pulled all the prior general liability programs for all three of the properties, for Boca, West Palm, and Pembroke. and we looked at what the prior premiums were, and then we ran loss runs for every single year for every property. And that was an undertaking because Philadelphia and Brown & Brown, the way they did it, they had them jumbled. So like you couldn't tell which was at which property. So we had to hand line it out to figure out what trip and fall happened at Pembroke, what trip and fall happened at West Palm. And so we were able to build this sheet to show 8 years of loss history. So if you go all the way to the bottom, it's 2012 to 2013, and then 13, 14, 14, 15, and it goes up to the current year, which is 2019, 20. And it shows broken out per location, the West Palm numbers, the Pembroke numbers, and the Boca numbers. So if you just look at last year, which was the 2019, the current program that we're in, as of July 16th, so this is about a week old, West Palm Beach had 25 reported liability claims, with losses paid are still 0, but reserved are about 50,000 with 1,000 in expenses paid. So you're running about a 44% loss ratio in the current year. By contrast, Pembroke and Boca, Pembroke had a very solid year so far where they're virtually claim-free, which is unique for them, and then Boca is running at about 14%. So normally we look at anything 40% and above is considered like a bad year, is what we, because carriers would typically not make money once it hits 40% on the account. And so I put in red any year, any one loss ratio exceeded 40%, which West Palms did last year. But if you look back, 2018, 19, and 17, 18, West Palm did very good. Only a 25% loss ratio in 18 and virtually 0 in 2017, which is very solid. And you can see, by contrast, Pembroke had a bad year last year and a good year in 2017. 2016 was bad for everybody. I mean, you guys ran an 98% loss ratio. West Palm and Pembroke both had bad losses. But what this sheet does for us is it's all about data. If we can get this data, this took days of work. But now that we have this, we can continue to add to it throughout the years. And I can go to a carrier and I can do 2 things with this. One, if you go down to the very bottom, in the last 8 years, the Senville properties have paid about $2.6 million in GL premium, and they've incurred $1 million in claims. So you're running a 40% loss ratio when you combine all 3 properties. So historically, this is not something I would use as an argument point right now, but Philadelphia is still underpricing, which I think we all knew, right? I mean, you're better than what the market is bearing, and it pans out here. They really should charge more if you look historically. But if you look at where it's happening from each one of the properties, West Palm is kind of middle of the road. You're running a 34% loss ratio for the last 8 years, which isn't great, but it isn't horrible. Pembroke, 86%. So they're the bad boy in the group, I mean, as far as what's driving the overall claims in the last 8 years. And Boca's the running the best at only 12% loss ratio. So it's kind of interesting. So West Palm benefits on the property the way it's broken out. Pembroke benefits on the liability the way it's broken out. Boca kind of splits both of them. But this data is huge for us, because going forward, when I try to pitch this account to a carrier, being able to show them long-term history, not just last year, I can go in and say, we can predict that this year you're going to have this many claims based on your history. And then when you combine that with Fred's work and fixing the issues that we found with the property, that's going to be able to take this to another level where we're going to have proof we've made these proactive repairs. We're going to hopefully have less claims, and then actually filing the claims, which I haven't even got into. We've revamped the incident reports, the process of filing a claim, how we're going to go over that process. Our hope is we'll be able to keep the actual claims down when they happen, and then be able to build around that, so that going forward, as the market continues to get worse, you will be kind of a gem in the rough, if you will. I mean, it'll be an ability of separating you from other clients by being able to show the data and being transparent. Yes, sir?
Just out of curiosity, we're in the middle in terms of the claims. The lowest organization had the lowest claim. Is there any data to explain why they had the lowest that we could use to drop ours? Is something they're doing that we're not doing?
Well, that's going to be the hope, is that we're able to do that going forward. We've only had a month or so of time into this, so we're not I can't answer that question yet, but my hope is that we'll be able to pinpoint exactly, as one's trending differently than another, why that is. I mean, we're going to have these claims coded differently, and this is all going to sound like mumbo jumbo, but it is super important to what we do on a daily basis. And so what I think the biggest advantage of us being involved versus the prior agent is going to be the agency support to Monica's team, being able to run this stuff. I mean, you report a claim, it's happening immediately. We're not waiting on that stuff. The information we need is correct. We're staying on the adjusters, because there's claims that settle that are very annoying that they settle for the amounts that they do, and the only thing you can do is be proactive and stay on them and try to avoid that. And I won't bother you with this too, but there's a whole nother sheet here that focuses on any open claims. So what we do is, as of this year, there is 1, 2, 3, 4, 5, 6, 7, 8. There's 8 claims that are currently on the liability side that are still open, that are still being adjusted. Only 2 are West Palm claims. There were 2 slip and falls. One's open for $10,000 and one's open for about $26,000. And we are on top of those claims now. But the date of loss on both of those was this year. So January 3rd and then May 22nd were the slip and falls. And we have... Oh, there's been
a few more since then.
Okay, so there's been some activity in the last 6 months when we look at it. Pembroke by far has the most open ones that are still there, although the big one in Pembroke from May actually did settle, so we were told that settled recently. So that was the big reserve that was sitting there. But anyway, we can at least then put this on paper and every year be able to target exactly what claims we want to talk about. Yes, ma'am?
Does the size of these villages make the difference also? As far as Boca, like we're big, they're small, does that affect it?
Well, the amenities, the exposures do have an impact. So, and you don't pay for their exposures. You know what I mean? Like they're paying more general liability premium based on their size of different things. You know, Pembroke has the golf course, which is a difference. So it depends on the different amenities and the exposure. So there's some difference, but I would tell you, in just my experience with this account in the last year plus, fundamentally, from a liability perspective, you're all pretty much on even ground. I wouldn't say that I would say one is tremendously more of an exposure than another. You all have the same type of operations. There's just a few differences with maybe size of theaters and stuff like that, and the golf course, the boats here. But overall, it's similar.
Thank you.
Yes.
Does anyone keep an eye on what I would call chronic and repeat claimants who view this as a new form of Social Security and keep making claims? Are we looking for things like that?
Yeah, we keep track of repeat claimants, and we always note that with the adjuster. We say, like, we have a person at another association. She just filed a new one as soon as her last one settled. She filed a new claim, and I told the adjuster these were the injuries she claimed, and we keep an eye on that.
And that's what's really good about the consistency. And so since we weren't here in the past, but we've done this data work to have the backup so that we can do that. Because what we're finding is the most important thing is that when a trip and fall happens, I want to know. I want an incident report that tells me what happened, but I want the background on the person. What do we know about this person? Because there's some things like, were they, if they were severely overweight, for example, was there things that contributed to the fall? Were there core mobility issues that led to it? Was it somebody that's a repeat offender? Is it someone that's angry with the association? We see a lot of spiteful claims that get put in out there where people, I had this lady tell me she wants to put a claim in because she's gonna fall. She told me, she's like, remember that one? She's like, in front of my driveway has mold on it. I know I'm gonna fall in there, put a claim in. That's not how it works. And then sure as hell, like 2 weeks later, she's like, I fell in the mold, and then I'm just like, God, people. I mean, so it's just nothing surprises me anymore, unfortunately. But it's fresh. But this kind of stuff, and I know you're gonna take my word for some of this because of it just being also new and us going through this data. But this will pay dividends for you in the future. It already has on the liability program, but it will continue to as the market degrades. Yes, sir.
When you began your speech, you talked about lower premiums for proactive solutions, and you can take this sheet. For us, for example, 2 years ago it was 0, then it went to 44. If I were an insurance carrier, I would ask, what have you done? what happened to create that 44? And if you can say we did this, this, and this, so that those instances will not recur, you will get a lower premium. We
Yeah.
will get a lower premium.
And that's the point, and that's exactly what we're looking to do by taking a dive into these claims, having Fred's team do the loss analysis, and that 3-day process that they did of walking the property and taking the photos and stuff, and then working with the teams afterwards. I mean, and Dan,
He's worked hard.
Yep, Dan's on it too. So you look at that will pay those dividends. It's hard to just take 1 year. So I mean, if I looked at West Palm at 44% this year, I have a ton of excuses. I could say, hey, some of these claims are fresh, they're open reserves, they may not settle for that. So we try not to look at the current year, put too much stock in it unless they're actual settled claims. But if you go back over time, that's why the 8-year history starts to prevent arguments. It's like, well, I can argue this year was bad or last year, but if I go over 8, that's a pretty good sample size. Then we start adding more on that, 9, 10, 11, 12. I mean, it'll help us. So that's kind of all I got. The only other thing I'd mention, and I know this is probably if you have trouble sleeping at night kind of stuff to look at, but page 24 and 25 is a sample of the market summary that we do for these accounts. So I want to make sure you know, and this is kind of what every agent told you when they came in here, but there's very little that Assured Partners or Brown & Brown or Plastridge or USI that we have that are different than one another. The carriers are basically fundamentally the same. We're all going to the same carriers. So when you guys trust us to bid the insurance, I mean, we do that very aggressively. And if you look at this page, you will see just some of the other property options that came in, like the other quotes we were getting. And I'll give you one that would stick out. If you got to go down this page a little, SRU was a program that last year quoted this property. They quoted the property with full limits. This year they would only do a $5 million primary. So they wouldn't even do $5 million of your $30 million. They wouldn't even do the whole thing, and it became way too expensive. You have other properties or programs like Velocity and Ventus, which were big players last year. They either declined, or one of them, Velocity, they offered us $200,000 in premium for the 25 million layer after the first 25 million. So it wasn't even the primary. I mean, like, some of these numbers were just, like, clearly would not work. One market that I'll point out, because I think you got to keep their name in your head for next year, is GEM. AmRisc recently, just some behind the scenes stuff for you. AmRisc, your current carrier, had a big broker that they worked with called All Risks. All Risk was recently purchased by RT Specialty. This is another big brokerage. And RT and AmRisc don't like each other, so they never had a contract. So All Risk got their contract pulled for AmRisc. But my point is that they are building their own program with this GEM carrier that they think will compete against AmRisc. So that would be something to keep an eye on for next year when that's done. We may have a program that can go kind of toe-to-toe with AmRisc and give us a better comparison. But you know, that's not there yet, and it's looking ways off. And another thing to point out here is the umbrella. So I told you we were very aggressive with the umbrella. If you go to the bottom where it starts with the Federal Insurance Company, which is Chubb, and go all the way down and to the next page, there is a who's who of umbrella carriers there. We didn't leave any umbrella stone unturned. I talked to markets that I didn't even know existed. So I mean, we went everywhere on the umbrella to try to improve what was there or to get the best we could. So this market summary is just kind of the backup for us, and we've got all this paper file as well. That we're confident what we're presenting you is the best options that are available. And no agent would be able to say differently if they were involved in the process. That's our goal. And that's it. I don't want to keep belaboring. I'm talking. If you let me, I'll stay here all day.
No, let Monica talk.
Any questions on any of that stuff? All right.
Thank you, Bill.
You are very welcome. Thank you guys. Very much appreciate you guys giving me the time to come in and do this. Making it work in these crazy times.
He's going to do the same.
Yeah.
You want to move right along, or?
No, let's go.
Let's go.
Take a bathroom break
No.
or just go into locker?
No, let's go to Monica. Let's keep going. So we get out of this room.
Ms. Monica? Yes, sir. Are you ready? I am ready.
Oh, well, let's go.
Sorry. Let me just find my right stack of papers here. I will see you guys in about
2.
Okay.
You're saving the paper clips, that's very
Thank you
good.
guys very much.
No,
Very appreciated.
paper clips.
Okay, everybody got your financial package today?
Yep.
No.
The first report that we're looking at is your statement of operations. This is for the 7 months ended May 31st, 2020. Revenue for the month is $367,000. Expenses for the month, $333,000. So we have a profit for the month of May of $35,000. For the 7 months, our revenues were $2.8 million. We spent $2.9 million, so we have a loss of $27,000. When you take a look at the year-to-date variances, when you're looking at your revenue, the largest item with the variance is your reserve revenues at $200,000, and that's because we had budgeted at this point in May, we thought we would have been well into replacing the roof at Hastings, and this is money that was budgeted to take from reserves to cover that. Dan, did we get our permit for Hastings?
Yes.
For the roof, yeah. So as we spend that money, we'll be taking the money from the reserves to cover that. So you'll see this go in the opposite direction. The other biggest thing, obviously, social activities year to date under budget $31,000. So our total variance for revenue is $230,000. When you look at your expenses, we have a variance of $99,000 where, for the profit loss from your budget for the 7 months, we have a variance of $99,000. But just looking at expenses, we're $329,000 year to date under budget. The largest line item is repairs and maintenance at $118,000. Salaries and wages at $56,000. That's again a result of the PPP loan that we had. Your social programs are under budget $59,000. Your security contract is under budget $11,500. So we're looking pretty good year to date, and we will expect to continue to see, as we discussed last month, additional savings, for utilities and those types of things as the facilities are permanently closed. So we did discuss all the individual line items last month. So any other questions on your statement of operations? Okay. Next report is your cash balances. As of May 31st, we have $953,000 in your operating funds, $826,000 in your hurricane deductible reserves, $1.9 million in your contingency and infrastructure improvement reserves, for total reserve funds of $2.7 million and total available cash $3,693,000. Any questions? Okay. Your next report is your estoppel income. This is through June, so November through June, there were 395 units that sold in this community. The prior year, the same period, there were 405 units. That is a decrease of only 10 units or 2%, which is much, much better than what I'm seeing in Boca and Pembroke. We're seeing much larger declines in the number of units being sold this year compared to the previous year. And also in that number in the prior year, the 405 included the 15 units in Sheffield O that we had purchased. So that was like a big one-time bump in the prior year. So having said that, we're doing even better than what it appears. Any questions? Okay. The next report is your revenue collected from guests, and there is no revenue, of course, being collected from guests. I presented this time because last month I had I think it was $125 mistake. I picked up a number from a wrong column and said there was guest revenue last month, and there wasn't, so I just corrected it for you. If there's no questions for me, that's it. Thank you.
Good morning. Just want to add a little bit to the insurance people that were here. It was a pleasure working with them, actually going through, after 30 years, actually walking through some of these insurance companies. I'm going to tell you it's the first time that I've ever had to help and also educated us on certain areas, especially now with the Triple Falls, learning about what we can do and work together. Our program, the Maintenance Connection, just to let you know, after looking at it in their apps, okay, that they have provided to us, we are looking into that area so that we can work together to actually, what he was saying, confront the areas that we're having problems in. So our Maintenance Connection program works in the same principle as their programs, and we're tying it into ours so that we can hit these areas and know by the end of the month or by the end of the year what our problems too, okay, where we had the most trips, because that's where I'm focusing the maintenance department due to the fact that he's saying, God, this is an unbelievable amount of money, okay, on the Triple Fall. Okay, so that's where, just to let you know, it was a pleasure. It was the hottest day that we had to go through, 3 days of 90 plus weather to go through there, but it was good. The other thing that she mentioned, we did get the permit for the roof, okay? We are planning to start with, of course, the rain has stopped that. We were supposed to actually start this Monday. We're starting the next following Monday, okay? On the work, you'll see the dumpsters in the back of Hastings. You will see roped off areas in the back of Hastings. And we had a job meeting, and we are pretty much got everything on how we're going to go about it and where we're going to start, so that we don't have to in any way stop the functions of the Hastings entranceway there. That's the only portion that we'll probably have to close for a day. That will be given ample time, at least 48 hours prior to that, knowing when we have to close the area, the entrance. We'll probably have another entrance to the side. We've done that in the past, but we actually had the entrance on the side to get to the gym. We'll do the same. Okay, moving forward with that. So it looks like that's moving forward. We also, I will be here for every inspection. Okay, so I made that clear that every inspection I will be here for that. So when they're calling in for an inspection, I will be at those inspections also. The other thing was in the tennis courts, just an update on that. Basically, we've worked it out with the contractor. Unfortunately, again, the rain has stopped. We were supposed to meet with the engineer out there 3 days ago. So 3 days in a row here with the rain, we had to stop this. So it looks like we're rescheduling it. Doesn't look like the same schedule that it's going to be rain for tomorrow morning also. So it looks like it will be Monday. All right, that we'll be doing that. I'll keep everybody informed. We met with Dom. Yeah, fencing and the tennis court over and something. I met with Dom. I told Dom that we would go out there too on the first inspection, that you'd see the poles properly put in place. Okay. The engineer, like I said, I'm not going to get into a lot of details, but the specifications that they have to follow, which Dom had brought up to our attention, is in there, and they have to follow those specifications. And so far, they've agreed to go forward with this. So I'm hoping that the rain stops here so I can get these first footprint in the ground and keep moving and get this thing done. Okay? So that's where we're at with that.
Can I say one thing on that, Dan?
Yes.
Just so you know, I know Fausto brought this up at the meeting last month, because obviously we had filed a claim for that damage from the tennis courts, and they had settled the claim, and supposedly the check was in the mail. So I contacted the adjuster for the claim and told them what had happened, that we now know that it was an inferior workmanship that contributed to the fence going down. Asked them to reopen the claim and close it, and not to send us the check, which is what they've done. Yeah.
The other thing that I wanted to bring up, I brought this up and I spoke to Dom, and Dave's not here, but we're going into budget, okay? And I wanted to see, I was talking to Eva and Monica, that we have a 3-year to a 5-year plan. We started this years ago with a gentleman, I can't remember his name. Howard. You know? But I would like certain people to, especially with the projects, and I'm under the understanding also that we have a major project with the air conditioning and possibly canals, that I would like a selected few to walk and look at the areas that we're projecting to show what budget or what we're going to do. You know, I brought up that we've had some over the past years. We've had the pool houses. Okay, Southampton was one of them. We have not brought up any of the pool houses to any ADA requirements. Okay, after going through the insurance people too, that's something that we're going to have to start doing. Okay, and budgeting in, and that's why I'd like to sit down with whoever selected few that you pick. Okay, to go through these areas. Okay, and prioritize what we want to do and how we want to do it in a 3 to 5 year period. When we talk about this, I would just tell you that I've done this in the other facilities, and I really want to sit down with you and see if we can come up with a strategy to see where we can go with this.
Dan?
Yes.
What is ADA, what is the requirements? What do we have to change?
Well, ADA is
the whole list?
basically, the only thing that you have ADA in that bathroom now is the door opening, okay? Everything else is not.
But if
the
you
old
just
code from 60 years ago was what you'll see, it's an oversized stall, which was basically not the it's past that point.
Thank you.
And again, people are looking into suing us because of that.
Oh, okay.
They've had claims, and we're talking to Fred, and now that we basically brought up the majority of all the other facilities in all the other Century Villages, hoping that will help also drop some of these claims. You know?
Yeah, I'm just curious because the Wellington pools are ours ADA?
All 4 are.
Yes,
Okay.
you just did that a year or so ago, Dom. I was there actually looking at when Dom was doing that.
Thank
so, again, you know, when it comes to your association pools compared to when I look at our pools, it's deep pockets, guys. Our insurance policies, there's a big difference between your policy on your building compared to our policy in here. And when they see and hear about that, that's where these lawsuits get up. And that's why it seems to me that they're hitting and tapping into the umbrella. Okay, so it's something, again, I'm bringing that up because I think it's important that we go back to that and having that selected few that we can go and prioritize it when we sit here and budget, everybody's in agreement where we want to go to. Okay, I think we started it, and I know you've put some monies away, and I know that there's basically the air conditioning and the canals that are big money. So I just want to put our budget on syncing with you guys, knowing where we want to go to. You know? So I leave it up to you to select that, and I'd love to walk around and show you what we have, okay, to prioritize where we want to go. You know, instead of popping so many things in front of you, okay, I just think that we should prioritize exactly what we want to do and keep the maintenance line where it really needs to be to maintain it. You know, so that's where I talked to Steve about this, and I talked to Monica, and I think we're all in agreement. We want to go back to exactly what Howard started a while back. Okay, so that's why you have the reserve money that you have aside, because the gentleman started back then. And any questions on that?
What was the bottom line here when you started?
About coming together, putting a small group together to create a budget workshop
Okay.
for projects, those that can go to the site and show everything that's going on.
Well, we did that.
It should be ongoing.
Dominic was on it. No?
Anybody?
What that was done?
I think it's
Did we not create a little working group?
Fell apart.
Huh?
It fell apart. That was Howard, when Howard was on the board.
There you go.
Yeah,
There you go.
So we've kind of fallen away from that. We want to resurrect it
Fine.
and create a small, anywhere that wants to volunteer, we'll appoint people or however you decide to do it.
And that way we can get the, prioritize when we sit here for budget, at least just so everybody has a good idea of what we're doing, so that we're not adding all these crazy things and saying and discussing back and forth. We're just
All right.
going straightforward where we want to go to.
Don, you interested in this?
Of course.
Yeah, of course. And, who else?
I have a question.
Barbara?
Oh, yeah, one of them.
Yeah? Yes. How many do you want?
That's a, like I said, what I want, if we're gonna be walking around, I'm gonna tell you, we're gonna go to these particular pools, because I wanna prioritize the pool. Of course, the reason that we picked Southampton in the beginning, okay, is just because we had a lot of sewage spills there years ago, if you remember, okay, where that has stopped, but I can tell you, behind those walls, it's definitely, it's gone. There's only, what's holding that is basically the studs and the stuff and the cement.
I thought we had repaired that, man. I remember you opened the wall up, it was black with mold.
Yeah, remember, we put money in, okay, we never got the money to redo, but we patched and repaired, okay, what we can, you know, without going, but, I want to bring the people out there, show them what we want to do, and everyone should be the same. We want to do the same thing like we've done in the other facilities, is basically we keep the landscaping at a minimum, we keep the fencing, we do, whatever we do in that. If you look at it, we got 5 satellites, in 5 years, you'll be able to get everything done with a minimal cost, and then what it takes to maintain, you know? So the maintenance guys that are out there to keep maintaining this, okay, there's a certain amount of money, okay, but the project should be concentrated on that particular and focus that, and go down a year, in 1 year, and we have it done. You know?
Anyone interested in this, please send me an email. All right?
Well, I just a show of hands. Don, Patricia, Richard, Fausto, Barbara. Did you say Joyce?
I would like to be, yes.
That enough?
Yeah,
That's
More than enough.
More than enough.
More than enough. You know, you
Too
don't want
many,
to,
isn't it?
Yeah.
Six.
Again, it's
around
the
here, if you
people
have
that you
6
wanna-
people, you have 6 different ideas.
Okay.
It's up to you, but like I said, it's focusing on people that we're looking at so we can prioritize the work that needs to be done.
All right. Anyone have second thoughts, let me know. Send me an email. I remember we were doing this. You're right, it was Howard.
It's Howard.
We were trying to put something together.
Yeah, I just need to let you know, and that's why I talked to you. And it's not that we've done anything wrong, but sometimes, you know, you put certain things in and you focus and then you let it go and you let it slide. If you really make that plan and stick to it, in the long run, you get to a point where Boca and we started this and pushing in Pembroke Pines, okay, and they got 27 satellites. You can imagine how long that's going to take. But if you just concentrate and put the money on that particular 2 pools at a time, you get to the point where you want, and you finally find out exactly how much your cost will be to run a facility. If you keep bouncing back and forth on all these items, okay, you'll never be able to get your money, okay, exactly where it takes to run the facility. So, and I'm really pushing hard to go that route because I'm seeing it working in the other facilities, and I even said that I would take a few just to take a tour, just to show you, because their price, listen, it might be, I don't go to the fancy, we're not that fancy that we're like Boca West or anything like that, okay? We're looking at the ADA, okay, making those bathrooms clean so they can last another 15 to 20 years if they're properly maintained, where you don't see doors and you know, things deteriorate.
I have 4 sets of drawings that the county accepted for our 4 bathrooms. So we can take a look at these and eliminate an argument.
Yeah. And we could, exactly, and what's really weird compared to the other facilities that we have, every one of our facilities are different. In the other facilities, they're all the same bathroom sizes, okay? So we do have 5, pretty much, I think 2 or 3 might be the same, the other ones might be a little bit different, but we can go with that same aspect to go forward, okay? So it's up to you, again, it's your money, and I think prioritizing is the most important. All of us working together, we can make this thing happen finally to go down in a 3 to 5 year period, getting this completed up there for the ADA, to meet all the bathrooms being ADA after 60 years. I think it's time, you know.
While you're there, this insurance guy said you guys went around.
Yeah, you missed our call.
Is there a list of,
yes. That's the,
you know, he said a couple of things that didn't make a lot of sense, that some of the latches were not self-closing.
Yeah.
Now, we were mandated a few years ago with those ridiculous new.
I brought that up, that's what we got hit here the most. I brought this up to the attention of EVA. We tried this latching method, which they approved, okay? The problem is we're going through a big expense because of the wear and tear that they get. The type of fencing you have, the chain link fence that actually hits this compared to a mechanical fence, and the pull-ups, okay, which now they're going through on the other facility, okay? We all had that same problem. Everybody, since we had the push-up ones, okay, everybody was upset with it. But unfortunately, the mechanical ones tend to work a lot better than your chain link, because the chain link is meant on a gravity, and you set it and it basically slams back in place. And every time that's opening and closing, that's moving. It doesn't matter. I don't care how you tighten how much you tighten it, it's going to misjudge, and you only have about a half an inch to 3/8, and then the latch won't catch. They're totally against this. They want this thing to work. That's a life safety out there. You have kids, even at the clubhouse. We got hit at the clubhouse because of the double. You came in from the parking lot, okay? You have not a gate actually. It's just a driveway gate where you open two big fences. It does not have the life safety, so we have to open up on the side and put a walkway, a little walkway, and put a fence there with the chain link and keep those two closed, okay? Because you have to meet those code requirements. Now, I have passed through the pool of Century Villages that we're able to put a one gate that will open inward because of the ADA. We requested that people have a hard time pulling that back out towards you. So we're able to do one gate, push inward, the rest of the gates to both push outward. Now, I can't do it in the clubhouses because that's the reason the code actually went into effect, okay? Most of your hotels and everything have a pool, and the exit from the building goes into a pool deck that needs to go outward, okay? So I can't do it at the clubhouses, okay, but I can do it at the pool satellites, okay? The fire department is making a meeting with Doug Weiss and all, as long as I let them know that we're renovating the pool, that we can make that happen, okay? So that's where we're at. We got any other questions?
So just to wrap that up, we're going to have to change out all of our gate system locks that we have now. We went to this, even though it's approved by the county, weight of the gates are working against us. And I know I've reported to the committee from time to time that we spend a lot of money replacing the locks.
We were going to put in a torsion strip and that was right that close.
We tried a lot of little different things, and I can tell you over the years between these things, even the door closers that I've tried, it's just out there in the weather, the sun, everything gets heat. Any other item, like you go to hotels and they have parts, so I was looking at how many parts. Everything is big money. We looked into this. It's gigantic. You're going to have individual keys, individual cards set out. It's a big cost to that. The reason that we went to this one is because we still had to keep it at the height that we needed to make life safety. It was all the way up here so that they could just press a button. Okay, but that unfortunately that latch with the weather does not last long. We go through a lot of money replacing these latches. Okay, and we're still having calls, and we had 4 of them when we went through our inspections. Where I went through the other facilities, okay, when we went through the mechanicals, including the ones that are still in chain link fences, push-ups, they were still working, okay? Now, that's 2 things. It could be also our people, how they're watching this, and we're looking at that also, okay, because of the day-by-day, instead of a weekly or a monthly check, they wanted basically an everyday check due to the fact that it is like safety. So we've changed that into the preventive maintenance program.
So, Dan, is this, because when I got here, we had this different one. Is it a plunger type?
Yeah, it's basically a push-up, okay?
A pull-up.
Pull-up per person.
They hated it. So, but
And
the
the
only
result was just contraindication because people would just prop the gate open.
Well, again, all I could do is follow that code requirement. Now, I can tell you we could keep going with this type, but it's costing you money, okay? They're not lasting, you know? So I'm looking into other portions that they would accept, and there's only certain things that they will accept, okay? At the same time, anything else is very costly. You know, any other kind of, to keep it low so that you could actually open up everything that you would have to open up with a key or card is very, very costly to hand out 7,000 units.
Yeah, because of the way you were also talking about a different type of fencing then.
Well, the mechanical, that's what I'm saying, when you get to the pool and we decide to, okay, even if you wanted to go back to that push up there, okay, you would have to make the gate higher, you know, you can't go to the regular, height. You would have to go up higher so that the pushing mechanism right now. That's why you see these gates that you have, they're up taller, okay? That would look kind of funny if you had a 6-foot fence going around. Most of the other ones are all going with mechanical fence, like the code requirement size, okay? Which is approximately 4 feet, something like that in that neighborhood. But they're not going to go up with a gigantic gate like that, okay? To make that happen, to what you have kind of mechanism, it all has the door, okay? And it's the best one so far that I can see that's lasted the most. Am I telling you that there's no maintenance? There's still maintenance on it, especially if how much you use the cooling. But if we could get, again, that can be done as you keep going too cool, schedule it out and change them out as you go along. And we could work on either the landscaping, the fencing, and the pool housing. Now, the pools are all in good shape themselves, okay? It's basically either the deck or the inside of the pool, okay? And if you concentrate on one at a time here, okay, that's what, and just keep your maintenance lines on what it is and average on everything else, okay, that you might want to do. But keep it so we focus on that one thing and it's done and we move to the next one, you know?
Where are we on the list?
Well, Dan covered the two, so he covered tennis courts and he covered the budget workshop. What I'll do as far as the date, Dan and I will figure something out and then I'll contact the 6 of you that volunteered to be on that budget committee. So,
what about Abby?
We're gonna go to Abby next. She's next.
I
Oh,
have
you
one
want more?
other thing to say, I'm sorry. But as I was doing my inspections with Casey's, with the roof and everything through there, looking at that building, okay, I just want you to know that I'm definitely getting prices. The stucco work on that, the paint job on that, okay, is definitely in need of done. You're seeing the stucco cracking, okay? It definitely needs some work on that outside of the building. And a lot of the deterioration around the building is because of the drain off, okay, that is causing a lot of deterioration on the bottom of these gutters on that on Hastings. So it's something that I'm going to bring up again with approval. We look on to prioritize things that I think that the outside of that building really needs to be maintained. Since we're doing the roof, and to me, is the outside shell needs to be watertight, you know, so that we work then from the outside. Okay. I just wanted to bring that up after the inspection that I did over at Hastings. Okay, thank you. That's it.
All right, Ms. Abby, go on.
I'll be quick. As I hope you all know, we're doing social media. We're doing really, really well in West Palm Beach. Surprise, I'm thrilled. We have programming through October right now. We're getting a lot of assistance from the paper. I'm going to ask Kitty for something in a minute. We've gotten a lot more subscribers. Our open rate was 28%, which on the average, a good percentage they're saying is 15. So we're really happy with that. To this point, we have not paid for programming. They've been other artists that already had programming that I've had relationships with that I've been able to get for free. And we're hoping to continue to get as many free programs as we can for Saturday nights. However, we are going to run out of content at some point depending upon when the theater opens. So one of the options is for me to pay for content. And the average paid performance content is between $2,500 and $3,500. The good news is that we have 3 communities that we can split it with. So I'm basically, which you have already approved to carry over the budget, if we don't open, the money will be there for me to pay for programming. And just because they're asking hypothetically for $2,500, which would be $750 per community approximately, it doesn't mean I'm going to pay that much. Because as far as I'm concerned, they already have that product produced. If I put $1 in their pocket, hypothetically, it's $1 more than they have. How they get paid normally is on the gross ticket sale. So in other words, if 1,000 people watch, if the Kravis Center puts it out and 1,000 people watch it and 1,000 people pay $30 to see it, they get paid on, the artist gets paid on the gross or the net, depending upon if there's ASCAP fees and BMI. We're not charging. I personally don't think we should charge either. I think everything's been free to us so far, even if we have to pay minimal dollars. We have the money in the budget. You know, we're spending minimal dollars marketing, you know, everything so far. We're not doing paid ads. We're just trying to get people to sign up on our social media pages. We just added this week and tested it Saturday night. We added a page to our website. So now you can go on Facebook, you can go on Twitter, you can get an email blast with the link, or you can go on our website, and it's right on the front. So you have 4 different ways to be entertained on Saturday nights. We send an invitation to you on Friday morning at 9 a.m.
Very good.
We tell you what the show is going to be. On Saturday night, you watch the show. You have 48 hours. Why am I limiting it to 48 hours? Because I don't ever want any committee or resident to say, well, I saw that show already. Why should I ever go to the theater to see it? So we're just trying to give you a taste of it. And I think 45 minutes is sort of enough time to sit at a computer or a laptop and so forth and so on. One of the other ideas that I would really like to pursue is I would like to invite performers into our theater, not into your theater, into Pembroke Pines. The reason Pembroke Pines is in Broward County. We have the approval from the county to open. We have not, but we do have the authority to open. The authority to open with 50% capacity.
I'm amazed.
So after speaking with our lawyers, that's correct. She would prefer us to do it in Pembroke Pines, which means Pembroke Pines would be incurring all of the expense, the lighting, so forth and so on. We have to feed the artists because they're going to be there all day. We would bring your personnel from West Palm Beach, the Boca personnel, Steve Cohen, and we would have 4 personnel on site. We would obviously be masked, 6-foot distance. I'd like to invite those performers into the theater, and at no cost to them, and we would actually videotape their show. We would edit it down to 45 minutes, and they can walk away with an edited video, which a lot of local artists do not have. What I need permission from you is Boca has a camera and you have a camera. Can I borrow your cameras? Your camera, this is it, I don't know.
No, this is the one at the theater. We
The
have
theater one.
right.
Okay. Can I borrow that? Because I understand you co-owns it. Can
Yeah.
we borrow, Steve Cohen or Laurent would be transporting it. Can we borrow your camera to do these videos? So everybody, every Century Village is participating.
Why not?
Great.
But if anything goes
Okay,
wrong with it,
good. We
who
will take
pays
very
for it?
good care of it, promise. Kitty, can I get this on Channel 63? It's how to subscribe to our, do you want it by email or hard copy?
I'll take the hard copy. I'm going to see from here that that can't go on. I'll have to break it down into a format that's readable on the television screen.
Okay.
So it'll have to be much
Would it be-
shorter. I'll take that and I'll make something up.
Okay, great. That will really
So
help.
it's on channel 63?
No.
What is your in-house channel?
590, 591, and 592.
Sorry, it's only because I know 63 and
There are
Boca.
3 community channels, and the decision is made when the kitty gets the material, which one it will go on. Barbara?
I think it's nice that we lend them the camera, but I want to make sure that if anything happens to the camera or any damage, that somebody will be paying for it, not us.
Well, it would have to be because
Well, I'm just bringing it out.
you would have, the only, listen, it could break here too. You know what I'm saying?
I'm just saying, but if it's out of our hands, it's in someone else's,
But
are
it's
they
in your
gonna?
staff's hands. It's still in the same staff's hands. It's in Loren's hands or Steve
So
Cohen's.
if anything happens, so we're still responsible.
Correct.
That's what I want to know.
But we're going to take it.
Excuse me, David, we have a tremendous, we're starting to get a lot of,
Say again.
Take the
I'm
mask.
sorry, I forgot. We're beginning to get a lot of equipment, okay? You have camera, John, how many cameras do we have?
We have this camera, and we have the camera in the theater.
That's
Okay.
it too.
There's 2 cameras. How much audio-visual equipment do you have in the conference room?
Oh, it doesn't work.
That doesn't work.
All I'm saying is, boys and girls, for a minimal amount of money, we can get a floater, put all the stuff on it, we can give it to her, and then we'll kill her if she doesn't return it to us, okay? All I'm saying is we can insure for a very minimal amount of money. But that's another thing that we have to think about, is that we have all this equipment and it has value.
Oh, yeah, I understand.
My friends always, I have so many friends who don't
System we
get online.
have in the conference room.
Hold on a second. She's asking a
I
good
don't
question.
know why a
Why would a
camera
camera
in
in
our
our
theater
theater belong
belongs
to you?
That makes no sense. Who
We
says it
recall-
belongs to
Eva
you?
told me it was.
We bought that camera in the theater.
Right. To
I was
replace
approached
that
by
camera, I
NPR.
did ask the question.
They were going to buy a camera
Yeah.
so they could video record the delegate assemblies.
The other option, I did ask.
Keep it in the booth.
Okay, I did ask Steve.
Right.
To purchase that and the tripod and the card that goes in it, it's about $2,000. So if you were uncomfortable with us taking that one,
No,
Okay.
we should have, bottom line is, it's time to we're starting to pick up equipment here, there, and everywhere. We got enough stuff in the conference room that'll, knock your socks.
Doesn't work.
Doesn't work.
Well, then it needs to be fixed then.
Sure.
One more quick thing, Fausto had asked about drive-in movies. We had already explored drive-in, shows.
Drive-in movies.
Yeah.
Who
It
does
is-
popcorn?
It is quite expensive, needless to say.
I went to
I
one.
have a whole proposal here that you can look at. But after speaking with, and I'm hoping that Dan will pipe in here too, obviously the liability is an issue. It's an ADA issue because in case you are not close enough to the screen to be able to see the subtitles, that is a very serious issue. With security, it's an issue with security, it's an issue with fender benders, it's an issue with going in and out of the bathroom, it's an issue with parking lot lights.
Right.
There's a lot of liability issues, but I do want you to know we did do our due diligence and we learned a lot, and thank you for that opportunity, but it's not going to be able to work for it. Listen, I would have loved it to work because I would have loved to potentially been able to do shows. I have one performer, you all know Tommy Mara.
That's good.
He has a bus, and he is more than happy to bring his bus here with his performers for free. Okay, but we can't set him up anywhere. So then I wanted to say, okay, well, can we drive him around the bus with just a microphone and drive him through the community? But the community isn't my, the roadways aren't my rights to do that. So we're trying to think outside the box. We're really thrilled with the response that we've gotten for these Saturday nights. The girls are working really hard to get this. We're getting this program. We're talking to everybody. We're hoping there's going to be a season. There may be a season. You'll read my article, which I read to you in the paper coming out. We're doing everything that we possibly can to try and keep you as entertained as possible.
Abby, I just have one question. I'm really amazed that Broward is open since they have even more cases than Palm Beach County. I wonder how they decided that.
Broward, I think subsequently they've stopped, but they've never pulled
required us to present a written plan of how we would reopen the theater in Pembroke Pines, and we were approved. They actually issue a certificate saying that you can legitimately be open. But the committee in Pembroke Pines said that they felt like they would look silly if they agreed to open the theater with the cases on the rise as they are. So they made the decision that they're not reopening their theater. It was only going to be for movies.
It was only
initially, but it's
I'm
still
just curious.
closed.
Thank you.
Yeah. I think they rescinded that for people now. I would assume.
I was
so.
wondering.
I've not heard.
Yeah, I don't know. We have the permission, so that's where we'll do it. And that's it.
Barbara.
Did we ever apply for Palm Beach County
You
for
can't.
ours?
You don't have the option to.
Oh, we don't. That's what I want to know.
No.
Interesting.
In this particular demographic, we are among at greatest risk, pre-existing conditions, age range. Why would you want to risk it?
But there's people out there that don't understand that, and they're right to us. Why is it that you're not having shows? Why is
There's
it
a lot of people that think we're all crazy.
that we're all crazy?
Because we're not open and we're not having
So,
card play and billiard play and everything else.
They don't understand.
I don't even bring in.
Anything else, Abby?
Good.
Thank you.
Thank you.
All right. So you'll have Reza Stevens and Robert Merrill. And
I'm bringing them back.
Workshop.
Boy, you're
All right.
dating yourself.
guys, where are we?
We are at the bottom.
Workshop.
Did we set a budget workshop?
No.
Yes.
Well, we have a group, And then
She's gonna get a
we're
hold of
gonna
them.
discuss it, and then I'll reach out to them with the date and see if we can all come together, and
Okay.
they will have a.
Fair enough.
Okay,
We're up to discussion.
yes,
Okay,
we're
good.
up to discussion.
I'd like to bring up two things.
Okay.
We're insuring two boats with no ID numbers.
Mhm.
If one of those boats gets stolen, what number do you give to the police?
Well, but he
Can't
had
we
a good
put a
idea.
number on them?
They
Motor
have-
vehicle usually can give you a replacement tag for that boat, and it will be registered with the state of Florida.
Right.
That's a liability issue.
Oh.
If somebody could steal it, we have no way of reporting
I
it.
think they're so old that there are a couple of them, you just can't read them anymore. So we're going to look into, because I made a note for myself about what to do. I mean, Phil says we can just pick a number and paint it on the boat, and he can add it to his policy
what he
and we're
said.
covered.
Right.
So, right.
That's what he
So,
said.
That's
pick a number.
number one. Number two,
yes,
it seems like we have a lot of amenities which are causing us to have an increase in liability issues.
right, right.
Pickleball, handball,
Right.
tennis, you pick them, we got it. I mean,
Yes.
they're all listed on there. Maybe